This is a new environment for me. It's not really VUCA, but I've never done a presentation in a cinema, right? I've always been on your side. So VUCA, anyone here has heard of this term before? No? No? Military buffs? Right, so this is a term coined by the US military back in 1987, right? The year my brother was born. I said, yeah, you're born, and then now you see the US military has coined a term specifically for you because you're volatile, you're uncertain, you're complex, and you're ambiguous. He didn't really like the joke. But now it's come back into vogue, right? It was popular sometime in 2002, 2008, and now it's come back again. So the reason why I put this here is, let's see, volatility. Who thinks global markets are volatile at the moment? Anything? Yeah, uncertain, right? Interest rates, are they going up? Are they going down? Are they going sideways? Fed, are they going to pause? Are they going to hike? Some more, are they going to reverse direction? We're getting a lot of uncertain signals. Even the best of us, fixed income portfolio managers, professional investors, are not certain, right? There's a lot of information out on Google, on so many platforms, right? I think if you did a poll, you probably get about 50-50. No, so I think it's uncertain. So the picture I chose here is, arrows, right? Pointing left, right. And I think that's what we are seeing. Ambiguity. This is what happens when I go visit my psychiatrist, right? They ask me to look at a picture like that on the right and I ask, do I see the bird? Do I see an animal? Do I see, right? So that's ambiguous, right? I think some of us can relate to that, right? What is the macroeconomic outlook for 2023? I think we started well, at least gathering from some of the people that I speak to, but now things have changed, right? The picture looks kind of ambiguous. And then complex. Interest rates, how do they relate to inflation? How does the war in Ukraine continue to play out? How does it affect investment decisions globally or in Asia? In Asia, US-China tensions, across the Taiwan Straits, you see some pieces of news. Philippines, naval vessel almost colliding with Chinese naval vessel. So not just are these macroeconomic, financial, but geopolitical threats all interwoven. How do they actually play out against each other? I think that's a very complex question, not something that I can answer. So I'll pause here to give you a kind of brief outline of what I will be talking about. So we have established that, I'm trying to establish that the market is, the environment we are in is a VUCA environment. And from an ETF perspective, so I'm the business development director at Nikko AM. In simple words, if you think about ETFs, my role is to try to get you to think about Nikko AM and vice versa. If you think about Nikko AM, my role is to let you think about ETFs. So we've got 2 ETFs that I'll be touching on today. We do have 6 in Singapore. I do not have time to go through all, but as my title suggests, I want to walk you through how in a VUCA environment, using one very specific case study, I would say, which is the wiping out of the additional Tier 1 bonds for Credit Suisse that happened about a month ago, how 2 of our ETFs reacted to this piece of market news. And then you can see, hopefully from that, we can extract how these 2 reacted, how considerations like duration of an ETF bond portfolio, as well as credit quality affects the performance, and how these kind of products react to it. And then from there, you can make your own decisions. You can come to your own conclusions, how it would fit into your investment needs, your investment outcomes that you want to see for 2023 and beyond. And then, that's at least a good starting point from there. So let's start from the top right-hand corner. Silicon Valley Bank, I think I heard the previous presenter talking about that, right? Signature Bank collapse, fears of a repeat of the 2008 crisis. Aggressive central bank tightening, that's happened already last year. Now I guess the question is it going to continue? Is it going to reverse? Is it going to pause? Credit Suisse collapse, that's the case in point that I will be going through in a bit more detail. Energy crisis, really, I think driven by the Ukraine war. Recession risks, that's overarching. High inflation, COVID-19, US-China tensions, and rising protectionism, and at the end of it, climate change. So this was sometime last year, last month. No, wait, we're in May already, so it's 2 months ago, right? Any one of you who held Credit Suisse AT1 bonds? No? I guess. Okay, no is good because it got wiped out. Right? So you can see even the FT, usually the more proper state kind of publications, they decided to draw a very big cartoonish headline here. It goes boom, right? And it says Credit Suisse AT1s vaporized. And then in Asia, shortly after that, one day after that, another article, Asian investors got smacked by 17 billion Credit Suisse bond wipeout. The immediate implications were, for me as the ETF Business Development Director, how did that impact your bond ETFs? And I'll go through that later. Right, but this is how I'm going to try to use the VUCA environment, a specific point in time, to see how our bond ETFs reacted. This is a simplified hierarchy of claim priorities. That means if I was a bank and I was borrowing money from investors, and if the bank went belly up, if it went boom, end of the show, it would go in terms of priorities to what is left, to what the bank owes you. Depositors should always be ranked the highest. And then all the way down would be common equity, that means equity holders of the bank. Why this case was so special was because FINMA, so the Swiss regulator, through an examination of the bond details or the bond credentials, right, decided that actually in this very specific case, right, the additional tier 1 creditors would actually rank behind equity holders, which, that whole scenario is still playing out. But this is special because in normal terms, if this hierarchy of claim priorities had been maintained, your AT1 bonds would not have been wiped out. The reason why this is such a big deal and why we're talking about it and why people are questioning us at NicoM, what's the impact on our bond ETFs, is really because the last two, additional tier 1 creditors, AT1 creditors, and common equity tier 1 holders, it flipped. And then people holding the bonds also flip table. Right? So jokes aside, because it was such a devastating blow to AT1 holders of Credit Suisse bonds, right? Immediately, or kind of almost immediately, you can see the dates here, March 23, March 22. What happened was regulators globally reacted and said, okay, we know what happened to Credit Suisse bonds in Switzerland. We know that AT1 holders were, in terms of claim priority, they were moved behind common equity. So what they came and they said was, for example, MS, they said that equity holders will bear losses before holders of AT1 bonds, right? Other European bank supervisors step in. So that's the Bank of America, Bank of England, for example, and Hong Kong also came up with the same thing, saying that this simplified hierarchy of claim priorities would be maintained if a similar situation happened for our country's bonds, so Singapore bank equity bonds. So how did the markets react? So I extracted, Bloomberg has got this global index of contingent convertible bonds or COCO bonds, which are essentially the same as the AT1 bonds. You can see that when news hit, the Credit Suisse AT1 debt was wiped out, you can see that the entire index fell, right? From about 130 levels to about 115, thereabouts. But where we are today, when we cut the data as of last week, 26 April, you can see there's more or less recovered back to pre-Credit Suisse AT1 levels. Okay, so there is resilience still in this particular sector, particular borrowing segment of bonds, right? So it has recovered, even though there was a lot of panic at the beginning. So bonds have obviously been in the spotlight even this year, even before the Credit Suisse situation happened. And this is just extracting from Citywire Asia, right? What they do is, I think they interview, they get a survey of professional bond managers, right? And this year, obviously, they're bearish, which explains the bear over there. And bond allocations by professional managers are actually the highest since 2009. Anyone remembers what happened in 2008, 2009? No? Everyone was too young? Sorry. Okay, so that was the whole Lehman Brothers Bear Stearns crisis, right? And usually, as we know it in most of our textbooks, is that during times of financial crisis, during times of uncertainty, ambiguity, complexity, volatility, VUCA once again, as evidenced by 2008 and what happened in 2009, bonds generally tend to outperform because there's this phenomenon called flight to safety, right? People use bonds as a volatility dampener, okay? And it seems like, I think there are fears that this year could be the same. So once again, if you recall my previous slide on the entire world map, there's the fears that, it seems to be pointing that there are fears that 2008, 2009 could happen again. And fixed income managers are reacting accordingly. And that's why they asked me to talk about bond ETFs today. Now I moved back a bit to macroeconomic factors. What do we look at if we want to see the health of the economy? The PMI, Global Purchasing Managers Index. So in simplified terms, if PMI is above 50, that means it's expansionary, right? Purchasing managers are looking forward and they're saying, we will be buying more, in very simple terms. If it's less than 50, it means that there could be recessionary pressures. They're not so confident about purchasing as much capital, for example, or assets going into the future. To make it easy to see, if it's in blue, if the lines are in blue, it means that it's in positive territory or above 50. If it's in the red line, in the red zone, that means it's pointing towards slowing growth, right? And as you can see, the two dark blue lines, which is the US and Eurozone PMI index, it's below 50. China was positive the last couple of months, but now it's just dipped again below 50. Singapore, for some reason, it's up above 50. Okay. And this, another indicator, another red flag, if you like to call it, right? Data points that investors do look out for when looking at the health of the economy, or whether there would be any signs of recession coming in, right? That's again one of the flashpoints, right? Is there going to be a recession? We look at the difference between the US 10-year and 2-year yields, right? Over here it says that US yield curve tends to invert prior to recession. That means when shorter US government bond yields are actually higher than the longer term US government bond yields. By right, or usually, in most circumstances, it is not the case. But when things flip, once again, if you think, when there's a flipping table, when things flip, people get nervous, right? It should not be the case. And historically, we have seen when this phenomenon occurs, 2-year yields are above 10-year yields, that is usually a sign, or market watchers would take that as a sign that there may be a soft patch ahead. So now that we've seen what the red flags are, what the potential red flags are, right, in the macroeconomy, looking at PMI, looking at the inverted yield curve, we look at the asset class. Why bonds? Why professional managers saying that bond allocations are up this year, right? I tried to boil it down just to 3 simple things. Income generation, because bonds, because of the coupons, you do get coupon distributions, usually semi-annually, right? So you would always get some kind of income sustainably and consistently. And that could be a hedge against inflation, for example. At least you do get some kind of returns back on a constant basis, right? You know that you're going to be getting your coupon payments all the way until the end. When the bond matures, you get back principal. Portfolio protection. This really comes because of the inverse relationship between traditionally inverse relationship between equities and bonds. There is a negative or low correlation between performance of equities and bonds, right? So you may be able to take some equity volatility in your portfolio, but some people, if you are a bit more defensive, you may want to look at bonds, right? Not just for the income generation that you get, but also to sort of like lower your volatility of your entire portfolio. And lastly, diversification. Once again, because of the low correlation to equities, that's really what you're diversifying your portfolio against. So this was just a very simple example, right, of what a defensive portfolio would look like if you think that's going to be a soft patch ahead. Right? You can look at many other indicators. I just shared 2 earlier. But you can see that fixed income allocation is about 50%, 40% equity, 10% cash. Right? And really 10% cash is really to help you get, to be a bit more tactical. So in case of any dislocations to the market, you actually do have some dry powder to spare. But really, the fixed income, this is where I want to focus on. Fixed income is still a very large portion of a typical defensive portfolio. So now it comes back closer to my home, right? Nikko AM and the Sing dollar bond complex. So we have, in general, if you see the 4 circles there, Nikko AM and our ETFs, our products, cover 2 of those circles, the blue one and the brown one. So how you read this graph is the more returns you expect to get from your bond investments, if you look to the right, you would see that you are also taking on more risk or volatility. So I'll start with the bottom left-hand corner, Singapore government bonds. That's really the safest corner of the Sing dollar bond universe you can be in. But they're not going to give you much, right? The returns is just going to be really safe, low returns, but you're also not going to take much risk. If you go up the curve, you've got government and quasi-government bonds, so that's Singapore government, quasi-governments, LTA, HDB, Sing Power, for example. Then you move up again, investment grade, so you're taking more risk now. You're taking on what we call credit risk, right? That's where you can see DBS, OCBC, UOB, Temasek, for example, SIA. These are the bonds, these are the issuers that you will be lending to. And all the way to the end, high yield bonds. So that's just an understanding of the risk-reward relationship for the Singapore context. Now, there are 2 bond ETFs, right? On the left-hand side, the ABF Singapore Bond Fund, which tracks the iBoxx ABF Singapore Bond Index. And we look at the issuers inside, almost 80% of it is the government of Singapore. So the really safest, right? If you're looking at AAA rated by all 3 credit rating agencies, you're not going to find many out there. Singapore has maintained its AAA rating for, well, a good long time. For as long as I can remember, they have always been AAA. Any threat to their status as a AAA rated borrower has never materialized, right? And that is always interesting because when there's volatility, there's uncertainty, remember, flight to safety, investors do think about the Singapore government bonds, right? Do think about this part of the market. Now, on the other side, you've got the iBoxx, Sing Dollar Non-Sovereign Large Cap Investment Grade Index. That's the index that the other bond ETF that we have in our suite tracks. You can see that there's still a large proportion, so about 56% of it is still getting exposure to very high-rated Singapore credit, meaning Temasek, for example, HDB, LTA, right? If they issue bonds, this ETF would be buying those bonds as part of the ETF's basket of bonds. You've also got banks, real estate, airlines, etc. So credit rating scale, both are safely within the investment grade complex. So all the way to the top, AAA, that's the highest tier. And then on average, the investment grade corporate bond ETF, on average, is single A. So that's still safely within the investment grade tiers. So this is something that I always have to remind myself, right? The price of a bond is always inversely proportionate to the yield. And the sensitivity of that is measured by a measure called duration. think about it as a swing. Oh no, not a swing, sorry. As a seesaw, right? If I go up, my friend goes down. So that's really the relationship between yield and price. Where does duration come in then? If I move back, in the middle here, in the two tables, you can see that the weighted average duration of the ABF index is 7.94%. And on the right-hand side, for the investment grade corporate bond index, that's 6.52. If you want to do the maths, if yields go down by 1%, and the entire portfolio of bonds, the duration on average, weighted average is 7.94, that means price goes up by 7.94%. Sounds good, isn't it? Yields go down, right? If we're thinking that, okay, inflation is under control, central banks will stop increasing their rate hikes, etc., we are seeing a reversal, yields come down, prices will go up by 8%. But that also means that the risk you're looking at is inversely. So if yields continue to go up by 1%, price goes down by 7.94%. But if you want to do something a bit less risky in terms of duration risk, right? That's where the investment grade corporate bond ETF comes in, 6.52. So yields go up or down by 1%, your prices go up or down at a lesser degree, lesser sensitivity to yield movements, right, at a factor of 6.52. So why is this interesting at this point of time? Why are we talking about it today? Because the top graph here, that's the ABF Singapore Bond Index. Historically, and we stretch history back to 10 years, at 2.84, is still higher than a great portion of this entire history of this bond index. So it is still attractive. It has come off its highs. It was almost as high as 3.5, 3.6%. But at 2.84, you can see, just by the line there, it's still above average. It's still quite attractive yields. If you're not invested in the bond complex at the moment, this could be an attractive entry point from a historical perspective. Moving down to the graph below, you can see that once again, 2019, 2020, 2020, what happened? COVID, right? How did bonds react? So equity markets were obviously not doing well, but you can see that the ABF, right, the safe haven asset class, did its job. It did well, right? 5.1% returns on a calendar year basis in 2019. 2020 was even better, so that's when we were in the midst of COVID, when all of us were in lockdown, 8.5% returns on a calendar year. That story changed in 2021 and 2022 because what happened then? Inflation started to rear its head, central banks started to tighten, interest rates started to go down, interest rates started to go up, bond prices go down by a factor of, what do we see? 7.948%. So that explains the returns there. But this year, is the story changing? That's still up for grabs. That's a crystal ball I do not have insights to. But by looking at the year-to-date returns, it's up 2.7%. Okay, I'll skip through because I'm running out of time. But this is really coming back to a balancer, right? Why are we looking at bonds? Because it's providing some kind of diversification from equity. Okay, similar story for the investment grade corporate bond ETF. Did well for 2019, did well for 2020, did badly for the COVID years, post-COVID years, especially when inflation and interest rates started to go up. But this year to date, it's up 3.5%. And once again, if you look at the graph on the top, 4.24, that's a credible yield from a historical perspective, all the way up to 10 years, right, to lock in these kind of yields at 4.24% for the investment grade corporate bond ETF. And there is a possibility, and I stress there is a possibility that if yields come down, if that is a trend that we're going to see later on this year, if yields come down, you do have the potential for capital gains. You've already locked in a yield at 4.24% on an index basis, right? There is some benefits of capital gains if you invest at this point. So this is, remember the earlier graph, risk and rewards ratio? This is really, if you think about it, as the Fed that you get if you invest in the corporate bond complex over the risk-free, the Singapore government bonds, right? On average, looking at this chart, you're getting about 150 to about 100 basis points spread over the risk-free rate or over similarly rated government bonds. So what does this mean? In the animal kingdom, if you've got some fat, right, what does it do? It protects you from, well, if you're a polar bear, it protects you from the cold. If you're a pig, it protects you from the tiger, right? Did I get the analogy correct? Okay, I'll try. But this essentially, if you are investing into the corporate bond complex, you're taking on credit risk. It just means that you're getting a little bit more protection in case of any movements in your yields, which could impact your price. And as you can see, that once again, if we draw back the data all the way back to, right, more than 10 years, right, 2012, I think, no. Well, I think we've got data all the way, but it gives you about 150, that's 1.5% more yield that you're getting just because you're taking on a little bit more risk, but you're still taking on very good credit risk. You're still getting, on average, A-rated credit risk. Now I'm coming to the end. We're looking back at how has this ETF, right, how has it been impacted by the AT1 saga? You can see that only 11% of the bond of this ETF was exposed to AT1 paper, but not European or Credit Suisse AT1 paper. It's all only Singapore banks. There is some exposure to Tier 2, 13%, but also once again, not Credit Suisse. So still relatively safe, or at least the impact isn't that wide, right? And if we look at how the entire market reacted in terms of spreads, these AT1 papers were impacted or widened after the whole saga. You can see that compared to the other countries, Singapore AT1 papers only widened by about 55 basis points. But here is where it gets a little bit tricky. And this is where, I think this is a very good slide, where it shows that the ABF actually outperformed the investment grade corporate bond ETF because as a result of what was happening in terms of market sentiment around AT1 bonds at the point of time, in March specifically. Because once again, flight to safety. If you're not certain what would happen to the AT1 paper, there was no certainty that it would recover back to Credit Suisse levels. Right? We saw that already happen. There was a panic, it went down, but it recovered again. But back in March, there was no certainty. So you can see that the ABF, which is the super, AAA rated bonds, did well. Because once again, flight to safety, right? Because there was some fear around contagion, what could happen to all AT1 papers, not just European or Credit Suisse papers, maybe even DBS or UOB AT1 papers. You can see that there is a underperformance versus the ABF. So therefore, in summary, so if you're a Singapore investor, Singapore dollar denominated investment grade bonds will number one provide you diversification, greater certainty of income. Okay? So in both charts earlier, interest rates have significantly adjusted from historical levels. They were pretty low, but that's over. So from a historical perspective, it is currently at an attractive level. Number two, we're talking about the Fed here. So corporate bonds, and we're talking about investment grade bonds, provides additional, relatively stable credit spreads of, once again, 100 basis points, 150 basis points to help you offset any impacts of rising interest rates if that continues to happen this year. And lastly, ABF, flight to safety, safe haven assets. Right? These are terms that we continue to throw out. Government bonds perform best when there's a risk-off market environment. We saw that during COVID. It did what it was intended to do. If equity markets suffer this volatility, a VUCA environment, it does what it is meant to do. Flight to safety asset, safe haven, it performs well. It performs best when it's a risk-off market environment. Interest rates are rising, but inversely, it is also weak when interest rates are rising during economic recoveries or when inflation is high. That's all I have in terms of sharing. The rest of it, these are just normal information you can find on our fact sheets. I hope that at least today there's a lot of ground to cover, but at least I tried to establish that in volatile, uncertain environments, there are safe haven assets that you can look at to try to tide you over. Why? Because income generation, diversification, some kind of protection. And then of the two, one reacted better for various reasons, either duration or credit risk, than the other. Right? So there's a lot of room to cover, but I'm still outside, my team is still outside, and we can answer any questions you might have. But at least this gives you an insight of how different fixed income strategies can help you, answer some of the really difficult questions when it comes to investing in 2023. Thank you very much.